G'day fools, I'm Margie Baldock and we're here to talk about all the volatility that's getting a few of us nervous at the moment with what's happening on Wall Street and the Australian market in the past few weeks. We thought it was timely to have a bit of a chat. So today we're talking with Scott Phillips, Motley Fool's Chief Investment Officer, and we're going to find out what Scott's takes are on the most recent market movements. Morning, Scott. Can't wait to hear what your thoughts are, particularly on this coronavirus. What do you make of it all?
Yeah, g'day Margie, g'day fools. Look, I think it's a really important conversation for us to be having right now because there is no shortage of chatter on the markets in general. I mean, man, if you're even close to social media at the moment, let alone the mainstream media, the major papers, there is so much going on above the fold when it comes to the big infection headlines. And then in the business section where it's, you've only got to look, as you've already mentioned, about the nervousness that investors are showing. So look, the first thing we should say is this is a really, really important and serious health issue, and we're an investment company, so we'll focus on the investing today. But we should absolutely put on record and say, this is very much, this is a tragedy for a whole lot of people, a whole lot of families in Australia and overseas who are dealing with what is first and foremost a health crisis. So let's acknowledge that it's a really important thing to not make too much light of or move on from flippantly. So we'll say that first.
Yeah.
From an investment perspective,
I travelled actually last week to Malaysia and Singapore. And I can say that the jumbo jet I was on was basically empty. So I hear what you're saying. It is really serious. It's not just people's health, but frankly, their financial situation is quite serious for a lot of people. So I think it is really important that we take stock and really assess the true impact of this and not overreact. So it is really timely to have this chat.
Yeah, I think so. Look, and the financial, the economic impacts are also really real. We saw the Chinese PMI number, the one of the key economic indicators out of China, have fallen to a level of about 28 or 30 now. Averages or not contraction or expansion is about 100. So effectively, the lowest level I want to say on record. It is absolutely indicative of what we already know anecdotally, which is a whole lot of production shut down, a whole lot of factories and shops shut down in China, particularly in Wuhan. This is a big deal, right? It's a big economic deal. We don't want to overlook that, and whatever optimism I have, which is a lot, by the way, for the market, isn't because I don't think any of that stuff is happening. It's the question for investors of, it is happening, so what do we do? What do we do the same? What do we do differently? What do we do now in the face of so much headline news, so much volatility, uncertainty, fear, quite frankly? And that's why we're having the conversation, because plenty of people haven't been through it before, or have been through it before, but frankly, because something funny about finance, we seem to have the shortest memories when it comes to investing of just about any industry, right? If medicine or science had the sort of short-term memory loss that we tend to have in finance, then we've been in a much tougher spot. So investing right now, it's really, really important that we focus on what investing actually is. Now, it's the long-term pursuit of compound returns. Now, if we keep that in mind, let's take those two in turn. Firstly, long-term, right? Long-term is not, believe it or not, a week or a month or even a year. We see people with long-term price targets of, X dollars, and that's over 6 months or 8 months. Long-term is not measured in months. So long-term is 3 years, 5 years and beyond. And the compounding thing. Compounding happens year by year over a very long period of time. You have to be in the market long enough for that to actually have its impact. There's a whole lot of studies out from around the place that say not only do managed funds tend to lose to the market averages, but the average managed fund investor loses to the average managed fund result because they chop and change too much. They don't hang around long enough to let compounding do its work. So that's the important framework. If you get that right, then it really recasts everything we look at when it comes to how, why, and when we invest. I'll tell you for free, I've said this in some of our emails to our readers and members recently, I bought stocks last week. The market was off, had its worst week in a very, very long time. I think it's the worst week since the GFC or something. They're kind of meaningless kind of stats, but that's what the media is talking about. So in the face of that, I wasn't running, I wasn't hiding, I wasn't freaking out, I wasn't selling, I was buying. Not, again, because I thought it was the bottom. It almost certainly won't be. I'm not that clever, I'm not that lucky to pick the exact bottom of the market. But again, I looked at the prices and went, well, hang on. These businesses are more profitable over the long term than the market's giving them credit for, because the market's freaking out about now or next week or next month. So, hey, if you want to give me a company on special, I'll buy it. Absolutely. I'll make it get a discount if you want to give me one. And so that's why I was out buying last week.
Well, so you're sounding a bit like Warren Buffett, where he would say, you should buy when everyone's panicking and so do the opposite of everybody else. So it's pretty normal for markets to overshoot in the face of a short-term panic. So if I'm hearing you correctly, you would suggest to our fools here in Australia who invest in Australian stocks, don't panic, nothing's changed, we've just got a short-term hiccup that we're all living through together. Is that the approach you would suggest?
Yeah, that's exactly right, Margie. I think, look, and it's really important not to try and forecast how long or short term this coronavirus problem is, because if you can't say, well, it's only the last 4 weeks, therefore invest, or I think the last 6 weeks, therefore invest, because at the end of that time period, people then start to say, well, I think you said it was short term, whatever they think short term is. So yes, that's absolutely baked into the assumption, but even more than that, coronavirus is here. It is a big deal. It is going to be a big deal for months probably. But the reality is going to be that depending on what businesses you're buying, if you're buying good businesses at good prices, they will outlast coronavirus. And so that's the important thing, right? If I know that, or I believe, and I'll pick some companies that aren't recommendations of ours just for the sake of it, if BHP is going to mine more iron ore in 3 years' time than it is today, why would I pay less for it today knowing that what that future looks like, right? Woolies is going to sell more cans of baked beans in 3 years' time than it is today, because it just is. Yeah. And so whether it goes down in the meantime, whether coronavirus is a big deal or not a big deal over days or weeks or even a couple of months, it's just not important enough. And as you say, the Buffett line, be greedy when others are fearful and fearful when others are greedy, it's a great line. Now, it's really important to separate out trying to time the market, which he doesn't do and we don't do, from just simply buying when prices are good. Now, timing the market says, the market's at a low, I'm going to buy. Oh, the market's too high, I'm going to sell. That's trying to guess where the market's going next. That's exactly what we don't do. What we do is say, what prices are attractive right now? Where should I put my money? If I've got a couple $100, $1,000, a couple of $1,000 in the kick, and I want to invest it somewhere, what are the best companies to buy based on that long-term future? If you get that bit right, the rest kind of follows from there. And that to me is the key story. We're not timing the market at all. We're simply saying buy anyway. And that's probably, look, I bought last week, and I bought a decent amount last week relative to what I normally do. But for most investors, just a very simple, if you're going to put X dollars a month into the market, keep doing it. When the markets are really high, let's say pick a number. Let's say it's $500 a month, right? Just to pick a number. If the market's really, really high, you'll get fewer shares when the market's riding high. And guess what? For that same $500, you're going to get many more shares if the market's down. And over the fullness of time, if the market compounds at 10% a year, give or take, the net result of both of those purchases is going to make you a lot of money over the very long term. So that's the key story here, is if you can't know where things are going next, then fall back on history and say, despite wars, despite recessions, despite oil shocks and stagflation, global financial crises, Asian financial crises, Grexits and Brexits, the market marches upward, not in a straight line and not without pulling back from time to time, but the market gains value over time, effectively no matter what. I mean, a couple of world wars, a couple of major regional conflicts in the last 80, 100 years, and the market has put on a heap, 10% per year on average over more than a century. That's what you've got to focus on. That's the big story, not what's in the news today.
So Scott, if some of our members are sitting back and saying, I hear that and I am going to buy more, but I'm going to wait for the bottom because maybe there's worse to come, what would you say to those people?
Flippantly, good luck. More substantially, here's the thing. In hindsight, this is why people use charts to invest or to try and invest, because you look back and say, see, if I just bought at the bottom right then, look how much more money I could have made. Or if I just sold at the top, look how much money I could have made. And so you try and think about, okay, I'll wait till the bottom. Now, we're recording this on Tuesday, the 2nd of March. As it turns out, the market's up about 2% at the time we're recording. Now, goodness knows what time what the market will be by the time it closes. It could be up another 2% or down flat or even negative with all the volatility we've had recently. But there were people on social media yesterday telling you how bad the market was. Now, I didn't say the market was going to bounce today. I had no idea if it would or not. But if you're waiting for the bottom, was yesterday the bottom? Are we now on the way up? Or is there another bottom to come? Or next time the market goes up, is that finally the bottom? Well, guess what you're going to do? You're going to wait. And maybe you're going to wait for another 2 or 5 or 10% and go, that was the bottom, but I missed it. Now I'm going to wait until the next bottom. Or now I'm going to wait till the next pullback. Or whatever you kind of tell yourself you think you can do cleverly. The reality is, unless you know for a fact you're able to, with proven experience, and be honest with yourself, don't have to be honest with me, it doesn't matter, be honest with yourself and say, unless you have a track record of actively and accurately being able to pick those market bottoms and tops over a long period of time, if you're that person, knock yourself out, do it. For the rest of us mere mortals, you're never going to be able to do it. So guess what the next best alternative is? is to invest regularly, almost mechanically. Just keep that money going in, because you're never going to know when the bottom is. You're never going to know when the top is. But if you invest anyway, history says that's the very, very best thing for you and I, and for everyone else out there who acknowledges they're only mortal. That's the very best way to invest, because that's how compound wealth is built.
So, Scott, it's a bit of managing our emotions through this volatile time. So as a final thought then, we're all going to come through this time somehow. What is the wisest way to rebalance or manage our portfolios to assist with the volatility so that we can manage those emotions and those animal spirits over the coming weeks?
Man, that is a perfect question, Margie, because the answer to investing well isn't the intellect. It isn't the process in itself. Warren Buffett, to mention him again, has said if you have an IQ above, I think it's 120 points, whatever he said you should sell it off. Sell off the extra IQ points. You don't need them. In other words, the smartest people don't win this game. And Buffett's own self-professed talent, his most important talent, is temperament. It's being able to manage those emotions as you go through this. Now, my usual best advice is be prepared for times like these before they happen, so you know how you're going to react, or you can at least think through what you might do. Now, a bit late now, we're right smack in the middle of it. Maybe we're in the eye of the storm, maybe we're out of it, we don't know yet. In any case, still like to prepare for that in advance. The next best advice is to think about what you're trying to achieve and how best to do it. And the only way I can think to do that is to look back into history. So those who've come before us, who are currently doing it still, those giants of investing who've paved the way to some degree, who've given us the playbook. I mean, frankly, if you've got some spare time, go and read Warren Buffett's letter to his shareholders for the last 50 odd years. I mean, that's, you can buy them in a book, it's $20. That's the very best way you can do it, because we've been here before. Remember that history tells us everything we need to know about investing, right? Nothing new has been invented in investing in the last 30 years. Quite honestly, all it is a different application, different circumstances of those very same principles. So over time, we know that buying shares is buying pieces of businesses. We know that over time, those businesses that are listed on the ASX or US markets have grown about 10% per year, not every year and not on a flat straight line, but 10% on average over time. And if you believe those two things have been true, and unless there's a reason for them to stop being true in the future, then that's the prize. Now, I'll leave you with one line that I particularly like, and that is, it is far more profitable to be optimistic and occasionally wrong than to be pessimistic and occasionally right. Because the pessimists are right sometimes, about every 10 years or so, and when they're right, so I told you the market was going to fall 40%, and that can be true from time to time. Guess what? In the meantime, the market's probably gone up 150%. So you want to be really, really careful what you wish for. Do you want to be right, or do you want to make money? So it is far more profitable to be optimistic and occasionally wrong. I bought some shares last week. I'm optimistic. Now, am I going to be right or wrong? Well, in the short term, the shares could fall another 20%. I don't know. And I don't really care that much. Like, it hurts to lose money. But if I'm right that the market will gain about 10% a year, and I've got a time horizon of decades, I'm probably going to live in.
You haven't lost money unless you sell them, right, Scott? So
that's
if you're not planning to sell.
Even those, hopefully, by the time you get in retirement, I'm hoping for most of our viewers now, they'll have enough of a nest egg. They don't even need to sell their portfolios at retirement. They're going to use those portfolios to create income. So some people will never sell their shares at all. They'll take income from those and pass the shares to their kids. I mean, if you've got a multi-generational horizon, you're doing fantastically. But even if you don't, even if you've got a small and growing portfolio, if you've got 5, 10, 15 years, the averages are well and truly on the side of a long-term investor.
Scott, I think that's some brilliant wisdom there. And if I was to sum that up, I'd say take an intergenerational view to your portfolio, and then it doesn't matter what happens this week, or next month, you're going to be bulletproof in your decisions that you're making. So, Scott, thank you so much for your time today, and full on.
Beauty, full on.